Hello and welcome to the Business Standard Morning Show. I am Pranjal Sharma. This is the first episode of a show where we will continue to bring you some of the most engaging issues around the economy of India. We will bring you face to face with the newsmakers and policymakers. We will also delve into some of the complex issue around technology and try to demystify those for you. We will of course give you guidance on what kind of investment opportunities are there, and we will try to make all the jargon simple for you. More than 2 years after its operations were suspended, Jet Airways is ready for takeoff again. It has submitted its operations plans again to all the authorities. But how easy will it be to go back to normalcy? Take a look at this report.
There is finally some good news coming from the aviation sector, which was desperately looking for relief measures to overcome the financial crisis in the wake of the coronavirus pandemic. Jet Airways is planning to resume its services by the first quarter of 2022. Just to remind you, the one-storied full-service carrier shuttered its operations in April 2019 due to financial woes, and the insolvency resolution process commenced in June the same year. And on June 22nd this year, the National Company Law Tribunal or NCLT approved the Jalan-Calrock Consortium's resolution plan for Jet, subject to certain conditions. Now coming back to the latest development, a person involved with the airline's business plan told Business Standard that the company had started engaging with the aviation regulator to revive Jet's operator permit, which had lapsed earlier. And the company had given a firm plan to the Airports Authority of India and private airport operators to resume its operations. So, what is Jet's plan going forward? Now, to achieve the target to launch operations on time, there have been 3 major appointments by Jet. The first key appointment is that of Sudhir Gaur, previously the head of operations and training at Jet Airways. He has been hired as an accountable manager and will have corporate authority for ensuring that all tasks comply with regulations. The second is Vijay Kumar, who has been brought in as head of engineering, and then there is Stephen De Mello, who will be the head of security. Well, everything looks good on paper and Jet seems to be ready for a second takeoff. But would the ride be easy, or does another turbulent one await the crisis-hit air carrier? We have with us Arindam Majumdar to list the challenges facing Jet Airways going forward.
Whenever Jet Airways restarts operation, it will face the same hurdle that the existing entrenched airline companies are facing. For example, the first will be the question of availability of slots. Jet Airways plans to restart as a full-service carrier, meaning corporate clients will be its bread and butter. So a corporate client is the line of a senior executive of a company who, for say, travels early morning from Bombay to Delhi for a meeting and intends to go back to Mumbai in the evening. Jet Airways, which during its earlier avatar held key prime slots at Bombay and Delhi and ran very lucrative flights like 6 a.m. flight from Bombay and return from Delhi at 7 p.m. or 8 p.m. The NCLT bench of Bombay did not assure the new management Jet Airways of getting historical rights over those slots, meaning they have to lobby hard. But an Indigo, which is adding a new aircraft every month, even every week, or a resurgent Go Air, which is looking to raise rupees 3,000 crore from a public listing, will not let go of those slots very easily, which they acquired after the airline was shut down in 2019. Second is the question of the funding. As we know, it's a very, very tough time for the aviation sector. Even market leader Indigo is losing rupees 30 crore daily, as they announced during the June quarter results. As and when a new player starts operations, it has to stabilize its network, stabilize its crew, stabilize its manpower at every station, and before that, it will be bleeding cash heavily. That is a gestation period. That will be a gestation period for up to almost 1 year. The new owners have to keep in mind that before the operations is stabilized, they will have to pump in and money heavily and regularly, like we saw the conglomerate Tata Group did in Vistara and AirAsia. Top management sources in Jet Airways have told us that the new promoters are very eager to see the airline back in business, and funding will not be an issue. And the second question is the competition. Not only Jet Airways will have to vie and compete against entrenched companies like Indigo, SpiceJet and GoAir. There is a new airline that is planning to start operations by the first half of 2022. That airline, Akasa, founded by ex-Jet Airways CEO Vinay Dubey and backed by Rakesh Jhunjhunwala, the wizard of Dalal Street, is in advanced negotiation with Boeing for an order of up to 177 MAX aircraft. Funding will not be an issue for Akasa. As we all know, Mr. Jhunjhunwala is well funded, and in a television interview, he has assured that how much funding the airline needs, he will be willing to invest.
Well, we already have the first roadblock. The NCLAT set aside the Insolvency Court's approval of the Jet Revival Plan after Punjab National Bank filed a plea challenging what it called an illegal reduction in its claim by the erstwhile resolution professional. For your information, PNB is the largest shareholder in Jet Airways with a 26% stake it secured after invocation of a pledge in 2019. The court will hear the matter on 21st of September. It's certainly good news that Jet Airways is planning to restart its operation. But as Arindam pointed out, the path ahead for the company is not without challenges.
There's good news coming on the economic front. The revival is becoming stronger and stronger. In fact, Finance Minister Nirmala Sitharaman says that the revival began in the first quarter of this year. But the question is this revival happening at the cost of the Indian middle class? That's a big question that we will get deeper into in this report.
Like most other things, there are two sides to the economic revival story. On the one side is the good news that the revival now seems real. While the country seems to be coping well with the after effects of the coronavirus pandemic, going by what Finance Minister Nirmala Sitharaman has said, the recovery may have started in the April-June quarter itself. Now let's also talk about the other side, the not so good side. Let's examine if and how the recovery is impacting the Indian middle class. An implication of the economy gradually getting back on track is that there could be a drastic reduction in job losses. Salaries and wages are also likely to be restored after initial rounds of pay cuts. This would put more money in the hands of the consumer and boost spending in the long run. But as the Indian economy gradually opens up, it is the middle class that is faced with higher prices, isn't it? Just think about your petrol and mobile bills. You would have received your LPG price hike notification too. Don't fret, we don't want you to panic. This is just a reality check with facts and numbers. Some of the most critical elements of daily expenses have gone through the roof, and the chief among them is fuel price. With petrol and diesel crossing 100 rupees per litre mark in several cities, there is a chain reaction pushing up prices of food and clothing across the board. Another big blow comes from air travel, as the government has eased caps on ticket pricing. The Civil Aviation Ministry recently raised the lower as well as the upper caps on airfares by 9.83 to 12.82%. As a result, flying within the country also got costlier. The lower caps were imposed to help the airlines that were struggling due to the effects of coronavirus-related travel restrictions. The upper caps were imposed so that passengers were not charged huge amounts when the demand for seats was high. Let's compare the old and new fares. Similarly, all the other categories, those with durations between 60 to 90 minutes, 90 to 120 minutes, 120 to 150 minutes, 150 to 180 minutes, and 180 to 210 minutes, also saw a significant jump in airfares, burning a big hole in the passenger's pocket. Now let's come to cooking gas. Do you know that the LPG prices have increased by Rs 165 per cylinder since January? Yes, you heard it right. In August, the price of cooking gas was increased by Rs 25 per cylinder. And in July, the LPG cylinder rates were hiked by Rs 25.5. If the trend for the 2 months are taken into account, a hike in September might be on the cards too. Now, the festive season is around the corner and perhaps you are planning to buy a new car. If yes, then there is bad news on this front as well. Yes, the common man's car is set to get costlier. The country's largest automaker, Maruti Suzuki, has announced a price hike across models from September 2021, making it the fourth such increase this year. While the hike was minimal in the last 3 rounds, this one could be steeper, pushed by an exponential increase in prices of raw materials like steel and copper. Maruti's move is likely to be followed by other companies. Tata Motors had raised the price of its commercial vehicles in April and July, while it raised rates of its passenger vehicles by 1.8% in May. The latest round of hike may dampen sales during the third quarter, which is the festive season, when auto companies sell the highest number of cars and two-wheelers. Now, if you think that was all from our side, let us give you one more surprise. Bharti Airtel founder and chairman Sunil Mittal has said that mobile tariffs need to go up significantly in order for it to be viable for telecom companies. Telcos are loaded with debt, and then there are hefty adjusted gross revenue dues or AGR dues and spectrum payments. And they are looking for some sort of cushion to sail through this crisis. Mittal highlighted the need to increase the tariff by as much as 33% by the end of this year and to double from existing level eventually. Though it's not clear if Airtel will wait for Vodafone Idea or Reliance Jio to hike tariffs or take the lead this time around. All said and done, revival is something most Indians would be, or at least should be, looking forward to. It brings about socio-economic stability. But what about the super hike in daily expenses that comes along? Think about it.
The last few months have seen the Indian stock markets gallop ahead and they are touching new highs every few days. The question is, why is the BSE Sensex and the NSE Nifty 50 rising so fast, so rapidly? Is this sustainable? And what happens to the retail investors? Should they be worried or should they make the most of this rally? We speak to some market experts to understand what's going on behind the rally.
For an economy that isn't entirely out of the woods yet, a massive run-up in stock prices is bound to raise questions. Back in May, RBI Governor Shaktikant Das had warned of a bubble in the stock markets as India was still fighting a second and more severe COVID wave. His warning, however, fell on deaf ears. Since then, the BSE Sensex has soared 12% while the Nifty 50 has advanced around 11%. In absolute terms, the BSE barometer of India's top 30 shares is atop the 57,000 mark, and the broader 50 share index is holding 17,000 levels. Strong domestic inflows, hopes of a strong revival in the economy and therefore corporate earnings, coupled with the US Federal Reserve's assurance that an increase in interest rates is still some time away, has given ammunition to the market bulls. No wonder then that the index of 50 blue chip stocks took just 19 trading sessions to scale the latest 1,000 points. However, within these factors, a substantial retail participation has been one of the biggest driving forces. Let's take a look at some figures. Retail investors now account for 45% of cash market volumes, with direct ownership at a 12-year high. Further, household investors purchased equities worth $5 billion in the June quarter. Compare this with FIIs, and you see a reverse trend. FPIs began investing aggressively in bonds for the first time in August 2021. In the past month, they bought bonds worth 12,144 crore rupees. In contrast, equity buying has stood at 2,083 crore rupees for the month. So, should retail investors take cues from their foreign counterparts and recheck their portfolio? Is equity investing getting riskier? Let's find out. According to analysts, stocks face plenty of potential risks that could dent the rally. The US Federal Reserve's policy changes, the spread of the COVID-19 Delta variant, and geopolitical risks may lead to a pullback in the rally, they say. Recently, Jyoti Vardhan Jaipuria, founder and managing director of Valentis Advisors, told Business Standard in an interview that as we had not seen any big correction since March 2020, so a time and price-wise correction could be due. Given this, should you invest in equities or go for bonds? We have with us Anil Sarin, Chief Investment Officer at Centrum PMS, to answer these questions.
As you asked yourself whether we should be investing at such elevated levels or that we should be investing at all, I think the answer is yes to both, only the context differs. Whether one should be investing in equity, absolutely you should, because it should be part of your overall asset allocation based on your risk assessment. But even if you are an older person who is risk averse, a little bit of equity investing is desirable because the alternative sources of investing do not give you anywhere near the kind of returns that equity provides. So to answer whether one should invest in equity or whether one should invest in equity at these elevated levels, my answer would be yes to both. Now, having decided that you do want to expose your portfolio to a little bit of equity risk even at these elevated levels, you need to be cautious about a few things. First and foremost, stop investing with borrowed money. At these levels, it is not good for you. It's very, very risky. Second, as far as possible, do not invest in unknown names based on tips or under-researched names. Let that be done by people who have better information or people who do that for a living. You, if you are not a professional investor, it is not advisable at these levels of the market to be going for those very, very small, unknown or tip-based kind of investing. Third, I would do a fair amount of research before putting money to work if I want to do it directly myself. I would recommend, as an investor, I would recommend that you go to sites like YouTube, which has a lot of material on a lot of companies, and some of the quality over there that I've noticed is actually quite good. And then there are all these newspapers and websites, etc., which are devoted to it. So do your work before you invest. Do not invest based on hearsay, based on what your friend has invested, based on what some big well-known investor has been putting his money into. Do your own work and only then go ahead with investing.
But what if one is not well equipped to do the research? How should you invest then?
Now, if you do not have the time or you do not have the ability or the inclination to do your own work, then it is best that you let it be done by a professional, some fund manager in a mutual fund or in a PMS or etc. Can do a better job for you under the circumstances that I shared where you can't do it yourself. If you still want to make direct investments and not go through an expert, then I think the way open for you is to go through the ETF or the index fund route. That is something which is very easily accessible by everyone at a low fee structure. You can get exposure, and over long periods of time it has been seen that even the best of fund managers struggle to beat the index. So my advice would be to stay invested in equity. Do not worry about the elevated levels of the market that there are. Over a long term, all these things will be taken care of. But trying to time the market, saying that the markets are elevated and I want to be out of it, etc., that would not be in your long term best interest. So, and to the extent that you don't know exactly how to do it yourself, let an expert do it. You still want to do it yourself, do your research. If you cannot do that, then go through the ETF route. That would be our advice.
Meanwhile, Deepak Jasani, head of retail research at HDFC Securities, suggests 7 golden rules, especially for retail investors, to safeguard their portfolio at current levels. Listen in.
Retail investors, old and new, are having a good time in markets lately, with Nifty touching new highs every now and then. However, one should not get carried away by this bull run and keep following simple principles in mind to avoid shocks when a sharp correction begins. 1. Be careful in giving higher and higher valuation to growth stocks, especially in sectors that are linked to commodity cycles. A sharp correction could knock off a big portion of their valuations. 2. Even in value stocks, they will have to be careful to check as to how much will the future cash flows be impacted by the changes in macro situation and emerging competition from disruptors. 3. Solid defensive stocks can be relatively safe, and even after corrections, this can come back to your entry level quite quickly. 4. Maintain your asset allocation among asset classes. In a bull run, often the weight of equities rises sharply. Profit booking at intervals and diverting these funds to other safer asset classes helps in maintaining this asset allocation and avoids the regret of not booking profits in a bull run. 5. Closely monitor the risks to the bull run, including the interest rate scenario globally, end of easy monetary policy, monsoon progress in India, commodity price cycles, inflation, and other macro numbers in India. 6. Keep better quality stocks in your portfolio and avoid going for the trap of turnaround stories in lower quality stocks. 7. In the current times, they should avoid applying in IPOs just to make listing gains. Only when they are convinced about the business prospects and the reasonability of valuations should they apply in such IPOs.
The Indian economy is recovering from a pandemic-induced contraction. While the midterm is looking a bit weak, the long term looks much better in terms of growth outlook. But the question is, will this be sustainable or not? Business Standard sat down with the former Deputy Chairman of the Planning Commission, Dr. Montek Singh Ahluwalia, to understand what is exactly going on with the economic growth momentum in India.
So now that we know that we are definitely in the middle of a recovery, what would you say are the immediate steps needed to sustain that recovery and to ensure that it's durable?
There are 3 or 4 things. I mean, look, at any given time, there are a very large number of things that can be done, and usually they're all on the agenda. But the question is, what are the next most important things to do in the next 2 or 3 years? Well, I would certainly say that probably fixing the banking system is the most important thing that we should aim at. That requires a serious look at what is needed to get the banking system in good shape. And, since the banking system is still dominated by public sector banks, the whole issue of reform of the public sector banks, to my mind, is an important one that we should see progress on. Now, I mean, in one sense, the government has made statements which do reflect a mindset change. I mean, for example, they've said that, look, in the long run, we want to make all the public sector banks private. That's a good move. But what is actually happening is an effort is being made to select 2 banks and privatize them. I have no idea what are the terms being offered for that privatization. I'm a little concerned that, if unreasonable terms are put forward, then you end up with a failed privatization, and then everybody then says, oh, well, we tried it, but it's not happening. See, to my mind, some of the things that need to be done are relevant across the public sector banking system. And I have been saying for some time that we need to remove the control which the government presently has over the public sector banks in terms of really too much detailed management. Um, I think the proposal that was put forward by the PJ Nayak committee, that if you can't get rid of majority government ownership of the public sector banks immediately, and I can understand that that is politically a very sensitive issue, then you could do quite a lot by simply putting all this equity that you have in public sector banks into a separate holding company which is run by professionals, and let them be responsible for putting in place professional boards that would manage the public sector banks, and the top appointments in these banks would be made by those boards and would not then go to the government at all. Now that's a bold step. It sort of moves a little bit towards the objective of running public sector banks more like private sector banks. And I think we should certainly experiment with that. I mean, look, if there's a resistance, why not take half the banks and do it there with them, and let the other half stay where they are under the control of the finance ministry, and at the end of 5 years see what does better.
It's been 3 decades since the PV Narasimha Rao government assumed office and set in motion radical reforms that changed the direction and speed of the Indian economy. Where do we need to go from here with regard to reforms?
Well, I think reform is a continuing process. I think what the Narasimha Rao government did, and I think they did that very well, is they took hold of a whole bunch of things which were interrelated and needed to be handled together, and made a lot of progress in that. I think the one area where they didn't make as much progress as they could have was the financial sector. And that remains an agenda item today. That's why I gave a lot of emphasis earlier that we ought to take on board a credible system of financial sector reforms. And we really need to do that if we want to lay the foundation for a stronger growth. So that's one item. I personally think that we need also to think a little more on what should be our longer term strategy on tax reform. Because, what's going to happen over time is that in the last several years, the ratio of tax to GDP has not actually increased. It should have. The idea of the GST was that it would lead to an increase, but it didn't happen. There's some recovery taking place now, but it's still much below what we would have hoped. So I think we need to look at the GST, and many government spokesmen have said that it is the intention to go to a 3-rate structure. I think if that is so, we should accelerate that. These are very concrete steps, and if they are taken, they give a sense that the government has a very clear agenda. I don't see any reason why we shouldn't wait for the next year. We should simply go ahead and introduce the 3-rate structure if it's possible now, or outline the changes needed for a 3-rate structure and sort of say that, look, we're doing the first batch now and the next batch will be done, 6 months later. That would be fine too.
Last but not least, in the medium term, can we get back to the high growth years? And if yes, how do we accomplish that task?
Well, I have no doubt whatsoever that if you talk about the medium term, once this pandemic is over, we can get back to high growth years. What those high growth years will be is an open question. I mean, remember, the global economy is slowing down. China is also slowing down. So whether we at one stage, in the 2000s, we even touched 9%. You may do that in a recovery, but on a sustained basis, it's not likely that the Indian economy can grow at that rate. Other miracle economies did it because they were the first to benefit from a large open world economy which nobody else was benefiting from. I think had we done it then, we would have benefited. They would have grown at less than 9% and we would have grown a little more. But today, the world is now much more open, much more integrated. So that sort of very rapid growth rate is not possible. However, for India to aim at 7% or even 7% plus is not at all impossible. We are a lower middle income economy at present. And, population growth is slowing down. Population growth is now probably around 1%. So, if we grow at, let's say, 7%, the per capita growth which that involves is about 6%. That's the same as 8% if you're growing at 2% per population. So a 7+ % growth rate in the medium term, in my view, is possible, and we should aim at it.
The government has notified new tax rules for Provident Fund, which means that all your savings in PF could be impacted. We speak to some experts and understand what this could mean for Provident Fund account holders.
Finance Minister Nirmala Sitharaman had announced in our Union Budget for 2021-22 that interest earned on employees' annual contribution beyond 2.5 lakh rupees to their Provident Fund, that is PF, would be taxed. Taking this announcement forward, the Central Board of Direct Taxes notified the rules for these on August 31st. The threshold was raised to 5 lakh rupees for cases where only employees contributed to the PF, not the employer. So, the first question which comes to mind is, what was the need to bring in changes in the existing PF structure? Earlier, interest on EPF was completely exempt from tax with no limits. According to the budget proposal, the government's aim behind this idea was to exclude high net worth individuals or HNIs from the benefit of high tax-free interest income on their large contributions. Now, the most important question: how will the tax be calculated? We will try to simplify this for you. For example, let's assume Shekhar contributes 12% of his basic salary to EPF, which is 24,000 per month or 2.88 lakh rupees annually. His employer contributes the minimum mandatory amount, which is 1,800 rupees per month. Now, Shekhar's opening PF balance for the year is 5.5 lakh rupees, while 2.5 lakh rupees of his contribution will be non-taxable. The excess amount of 38,000 rupees will be taxed. At the end of the year, his non-taxable contribution will be 8 lakh rupees. On that, assuming an interest rate of say 8.5%, he will earn 68,000 rupees interest. The taxable portion will earn an interest of 3,230 rupees. This amount earned in 2021-22 will get taxed in the employee's hands in the assessment year 2022-23 under the head Income from Other Sources. And if the interest income exceeds the threshold limit of 5,000 rupees under section 194A, tax will be deducted at source. Now, this explains the mathematics. But there is still a grey area in this story. There is no clarity on how the taxable interest will be calculated and separated from the non-taxable portion. It means the EPFO is yet to formalize the separation of taxable and non-taxable contribution in the accounts. We hope that CBDT will soon come up with a foolproof plan to rule out any glitches.
Well, that's all we have for you in this episode of The Morning Show. We'll be back again with another episode very soon. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.